Homeowners equity recently hit over $16 trillion, which in tappable equity, which is the amount that a lender is going to let you take out of that, over $10 trillion. This is a new record, and per homeowner, that's over $200,000 in equity in their home that they're able to take out. But the problem with this is, most homeowners have such a low rate, they don't want to refinance and get the cash out. But the good news is, there's a couple ways that you can actually take the cash out without losing your super low rate. And if this information helps, definitely like my channel and subscribe. So first, let's talk about reasons why people might want to take money out of their home. There aren't really any restrictions on what you can use the money for, and there's a lot of reasons that we see people taking money out, and here's a few examples. First, and probably the most popular, is to pay down other debt at a higher rate. Now, I know you're saying, oh my gosh, mortgage rates are so high, how can I pay off debt at a higher rate? But let's say you're doing a HELOC and the rate's at 7 or 8%. Well, you might be paying off credit card debt that's at 25%, and that definitely can save you money in the interest payments over the long run. The second most popular reason is putting that money back into your house, either doing like a great remodel or adding on, or even just fixing it up. You obviously don't want to move with such a low rate right now, so anything you can do to extend your life of the house is always a great thing. A lot of times we also see people taking some money out of their house to help pay for their kids' college, especially as expensive college has gotten these days. And another big option we're really starting to see as the economy is starting to change is people taking that equity out because they have other investments that are going to make more than they're paying in the interest. And the last reason, just because people want to buy things. So people buy like cars, motorcycles, RVs, jet skis. So whatever you use the money for, you want to make sure that taking money out of your house definitely aligns with your financial goals. Now the question is how? Well, you actually have two options, and in both scenarios, you're going to keep your first mortgage as it is, and you're going to do a second loan. Now the first option is just a straight home equity second loan. And how this works is basically it's just a fixed rate loan, and you get a lump sum of cash out at the time of closing. The good reason to use this is because you get a fixed rate instead of a variable rate, and you get all the money up front in case you need to use it right away. And the second option is called a HELOC, or home equity line of credit. Now how this works is instead of getting the lump sum up front, you get a line of credit. Now you can take money up front, but you have a 10-year period to borrow up and down on that line of credit until it goes back to a fixed period for the last 10 years. The good thing for this is, let's say maybe you need $10,000 up front, and then 6 months later you might need 15 more thousand. You can take that as you go, and your payments are interest-only payments only based on the amount of money that you borrowed up to that time, as opposed to having to pay that full amount up front like the home equity fixed loan. Now the downside of the HELOC is the rates do adjust. So if mortgage rates continue to go up, your HELOC rate's going to go up as well. But it does give you a lot of flexibility if you need it. Now, there's no right or wrong answer on either one of these two products, except the fact that you get to keep your super low rate. And if you do have questions or want to go through the pros and cons of each and see what fits best for you, contact me to learn more.